Welcome everyone. Thank you for giving up part of your evening this morning to come here and listen to me speak about self-managed superannuation funds. Look, I'll be talking for about 40 minutes or so as a part of the formal part of the presentation. We'll have plenty of time for questions. If you've got burning questions that you can't wait to ask, just indicate and we'll try and answer a few on the fly. We do have a fair bit of material to get through, so we'll keep things moving along as quick as we can. The theme of self-managed superannuation funds, and I'm sorry that I'm standing over here and not talking to you. If I keep walking across here, I'm going to get lost a little bit. The topic today of self-managed super funds reminds me a little bit of an experience I had last year. About February last year, I signed up for a charity bike ride to ride and to raise money for the Future 2 Foundation. And the first thing I had to do was go and buy myself a road bike because I'd never really ridden a road bike before. Now, I stepped into the bike shop and was absolutely bamboozled by jargon and technical know-how from these guys trying to sell me bikes. And then came the nutritional advice, which I had no idea about. And then there was this enormous amount of training that I had to do. And it was just all overwhelming. And I sought the advice of a couple of friends who are expert riders, and they were able to break it down for me and really help me with that jargon. And I think there's a pretty clear line of similarity with self-managed super funds because there's a hell of a lot of jargon with self-managed super funds, and there's certainly a lot of technical knowledge that goes into the running of self-managed super funds. But with the right advice, they should be available to almost everyone. So hopefully tonight you'll walk away with a bit more knowledge of some of the jargon that we use, certainly some of the terminology and strategies you will have seen before perhaps, and we will be scooting through some of the areas fairly quickly. As with always with our presentations, it's general advice where we're not taking into account your own personal circumstances when we talk to you about these issues today. And so if you do want to implement some of these strategies, please seek advice from an appropriately qualified person first. It's a lot to cover, I know. We're not going to go into detail on every single one of these areas. What we will be doing is delving into a couple of them in a bit more detail, skimming over some of the others where perhaps you've already, maybe already over those areas. So let's get started. I thought the best place to start was just how we get money into your super fund. It's fairly, two main ways is through rollovers or through contributions. The rollover being a transfer from another super fund to your self-managed fund. Before you do that, your self-managed fund has to be able to prove its bona fides, and there'll be some information that comes with your, those rollovers that must be kept for the life of your fund. Contributions are split into two distinct areas, concessional contributions and non-concessional contributions. And we're getting to the jargon now. Concessional contributions are those contributions generally come from employers, or unless you're self-employed, there'll be personal contributions that you're claiming tax deduction. There's a cap on how much you can put in under a concessional contribution, being $25,000. If you exceed that, there's extra tax you have to pay. That cap is likely to be increased by around July 2015 through the indexation of these caps. However, as you may be aware, there's been some recent proposals to perhaps even change that further. Non-concessional contributions are your own personal money being put into your self-managed superannuation fund. So whereas the concessional contributions form part of the taxable benefits of your super fund, your own money going to the fund forms the tax-free part of your benefits in the self-managed super fund, and that's something we'll talk a bit about a bit later on. There's, again, a limit on how much you can put in under a non-concessional contribution, $150,000 a year, or you can bring forward 2 future years into the current year and contribute $450,000. Now, this is an area where the tax office has found people are making errors and getting fairly significant amounts of tax levied on them for exceeding those caps by incorrectly applying the 3-year bring forward rule. So I suggest it is an area that advice is probably worth getting. You can also, if you run a small business and can satisfy the small business capital gains tax concessions, you can put up to $1.255 million of your proceeds from the sale of your small business into your self-managed fund. It doesn't come under any of the contribution caps, so it's a really exciting way to get extra money into your self-managed superannuation fund to provide for your retirement without exceeding caps. A very complex area. You need tax advice, you need to talk to your accountant about it, you need and really make sure you satisfy all the tests correctly. Getting your money out of the self-managed fund is fairly straightforward. You can only take a lump sum or a pension. There's no other real way you can get money out of a self-managed superannuation fund. There's a few conditions you've got to be able to meet. If you're under 55, you're probably not going to be able to get your money out of superannuation. It's generally the first hurdle you need to hit, and that age of 55 is gradually going to increase to 60 over the next few years. Between 55 and 65, you can withdraw your money from superannuation depending on certain circumstances. And once you're over 65, there are no restrictions. That 55 to 65-year-old age group is where we're looking at the strategies around transition to retirement, which you may have heard us speak to you about before, whereby you can start drawing a pension from your super fund whilst you're still working. If you've retired and you're over 55, but not yet 65, you can still take your money out. So there's no restrictions if you're retired. But if you're still working, there is a restriction. You can only take a pension, and the pension can only be up to a maximum of 10% of your benefit in the fund. With all pensions, there are minimum pension requirements that you have to meet. You must pay a minimum amount each year out of the fund. And you can stop pensions as well. So it's quite flexible around, you know, making sure your self-managed super fund actually meets your requirements along the way. With self-managed super funds, as opposed to a general public offer fund, as the trustees of your fund, you are in control of your fund. That also comes with extra responsibility, because when it comes to estate planning, you need to start thinking about, well, what's going to happen if I die? Or what's going to happen if I become incapable of running my fund? So let's deal with the first one. Your self-managed fund can't be directed by your will. So if you were to die, the trustees of your self-managed super fund cannot be directed to pay your superannuation benefits wherever you want by your will. There's only real two choices when it comes to where your money can go. It can either be paid out as a pension to your spouse or to a minor child, or it can be paid as a lump sum to a dependent or to your estate. Now, in terms of the pension sides of things, if your pension is if you're retired, for example, and you're receiving a pension from your super fund, and you pass away, you can make that pension automatically continue being paid to your spouse. It's called a reversionary pension, and that can be a great outcome for some people. And one of the benefits of that is, of course, that the money stays within the self-managed superannuation fund environment, which is a tax-effective environment. Child pensions are also very effective and tax effective if a parent dies and they want to have money being paid to their children to fund school fees and whatnot along the way. So there's some variants of strategies that can be used there. When it comes to lump sums, it's fairly straightforward. If the money is paid to a spouse or to a financial dependent, there is no tax payable. But if it's paid to a non-dependent, and that includes an adult child, then that taxable portion I was talking about earlier, that attracts tax at 16.5%. So there's a de facto tax, death tax. So it's one of those things that we like to spend a bit of time on looking at in terms of strategy. So when it comes to looking at issues around estate planning, you need to think about who you want the benefits to go to. You need to think about control as well. If you opt for a reversionary pension, it's no longer your money when that pension reverts to the new recipient. So if I was receiving a pension and I was to die and my wife was the reversionary pensioner, so she automatically starts receiving that pension, I no longer control that money. My wife, then, it becomes her pension and she can do with it what she likes. It may be important to consider that if you're in cases of blended families. Of course, overriding all of this is taxation efficiency. That's death, but what about if you lose capacity? How do you look after things then? Ideally, your money stays within your superannuation fund because of the tax effectiveness of having your money invested in that superannuation environment. And really, the answer is an enduring power of attorney. So it therefore follows that anyone who's got a self-managed superannuation fund and is a trustee of that fund should have in place an enduring power of attorney. Because without that, it's a bit hard to control your superannuation benefits because you can no longer be a trustee when you're full capacity.
Chris, excuse me, explain what an enduring power is. I know what it is. Explain here to the people that it's during the normal power of attorney and enduring power.
Yeah. Thanks, Rowan. Look, in the interest of brevity, I won't go into lots of detail around some of these terms. An enduring power of attorney is if you become incapable, your power of attorney can still operate on your behalf, whereas a general power of attorney that ceases to operate once you lose your capacity. So there's the importance is in having the enduring as part of that power of attorney. In terms of death, upon death, your executor steps in to take over your role as trustee. It's only an interim role though. After the first payment out of your super fund as a death benefit, the executor can't stay there in your capacity unless they are formally appointed as a trustee of the fund. Something to keep in mind and perhaps to think about in the arrangements that you're setting up for your fund. One of the issues with control is also what happens when you die. A famous case, which you've probably heard us talk about, is Katz versus Grossman, where there was no binding death benefit nomination in place, which could have solved a lot of pain for the people involved. The situation was briefly, husband and wife had a self-managed superannuation fund and they had a daughter and a son. The wife passed away and the husband, for administrative ease, appointed the daughter as co-trustee of the fund. All fairly normal. Then, and his will said that all of his assets were to go 50-50 to his children. He then passes away. His daughter appoints her partner as co-trustee of the fund, and they exercise their discretion, because there was no binding nomination, to pay the benefits to her. The son challenged this and lost. He then challenged the estate for a greater share of the sale of the house properties and lost. The message is a binding death benefit nomination would have solved that problem. A binding death benefit nomination binds the trustees to pay your death benefits where you want them to go. And the requirements are fairly straightforward. Your deed has to allow it. The nomination must be to a dependent or to your estate. And it's got to be renewed every 3 years. If you don't do any of that, then it's invalid. And so we go back to the aforementioned case.